Does it sometimes feel like there's so many different ways to invest that it may be a little difficult to figure out the philosophy or the approach that you should take? In this episode, we'll talk about why picking a philosophy is a little bit less important than you think. There are many different ways to approach investing, as you've kind of learned over the last little while.
Year.
Yeah, or so, yeah.
So,
And it can definitely be overwhelming to a lot of people. In fact, sometimes it can even be a little bit overwhelming to me. There's literally hundreds of slightly different approaches, and they will all kind of say that that theirs is the best way. But objectively, there kind of isn't a best way. There's not like a one perfect way to approach investing. And I would argue that a little bit, because I think there's the data points in a very specific direction. But even within that world, there are slightly different ways. So something that I have noticed is that, especially with some new people that I'm working with, I guess, is that when you have preconceived ideas of the way that you want to invest, it can be very difficult to adjust the approach that you're taking, especially when it isn't objectively better than what you was doing or objectively worse than what you was doing before. Does that make sense?
Yep.
So I always encourage people, if you're going to work with an advisor, that you use their investment philosophy. Why do you think that I would recommend that?
Because they know it best. Like, they probably have studied it. They've, like, I know we've talked about, like, your specialty, your niche is corporation owners and specifically engineers. So you know them well. So since they know it well, if they have, it's almost like they do it systematically, I think, when they have a philosophy. So it's like, this is my philosophy, this is what I know, and I do it across this wide spectrum. So I have a deep understanding of it versus, oh, this client does it like this and this client does it like, there's no time to like deepen the understanding of it, if that makes sense. So it's like, if you're working with an advisor and they're like, this is my philosophy, you should stick with it instead of like trying to push them towards something else. You should find an advisor who specializes in that.
Yes, you're pretty much spot on. Is that especially the more planning orientated advisors like me, for instance, I'm very planning orientated. I spend a lot of time on the tax side of things. The way that you invest and the philosophy that you're investing with is what you spend your time going deep into and figuring out, okay, what's the optimal way to approach various tax situations based on the investment philosophy and what I expect to come out of that investment philosophy. Does that make sense?
Yep.
And as soon as you start adding in and deviating from that, that does mean that the rest of the planning or the other part of the advisor's expertise that is very deeply intertwined with that specific way of investing is now mute.
Yeah.
Right. So a really good example of that, I'm going to just use my own, for instance.
I just want to also throw out, sorry, not your example, but the COGS.
Yeah.
That's literally it, right? Like, one thing, like, this is the overall philosophy. You're looking at the board of COGS and then you're like, oh, but I want to change this cog. It's like, well, you can't just change that. Everything else is now different. Sorry, go ahead.
That's exactly right. And then there's an example is, for instance, let's say that I am using my Canadian core equity that I use. It is, because it's a market-based, it's an index type fund, it spits off about 3% in Canadian dividends every single year is kind of what I can expect and kind of plan around in that range. If now, instead of using that approach, I choose to go down a high dividend approach where that portfolio is now spitting off 6% in dividends, it might seem small. What's 3%? But when you're looking at now passive income rules inside of a corporation on how much I can be receiving so that the small business deduction doesn't get ground down, well, that's now all changed. Now when I'm looking at, how much income, how much percentage of the assets should it be in a non-registered account versus interest income versus all of that type of thing, so that the elderly individual doesn't have to pay too much to support for their healthcare needs, that's all now thrown off purely because of what seems like a really small decision, because I've spent my time figuring out optimal paths for very specific expectations. And while, yes, you can redo all of the math around that, the reality is it's extremely inefficient, and there will be somebody out there that has built their planning and everything like that around that strategy. If you want really high dividend strategy that focuses on those type of things. So that's why it's just really important to, whatever you are picking, to kind of stick with that approach. Does that make sense?
Yep. Yeah. You can't, yeah, I feel this in the finance world overall, is that because money is so tied to everything, and everybody uses money and all of these other things that we've talked about behaviorally, people think they should know, right? And then some people decide like they're using banks, advisors, whatever, planners as order takers to like a means to an end. It's like, this is what I want, and I think I know best, so you're just like the middleman to get what I want. Whereas you can't, unless you have that level of knowledge and that depth and understanding, like that's not the right approach. It's like we don't do that in a lot of other areas in life, like in where you're hiring someone for their expertise. You don't say like, this is what I want and I'm sticking to it and I'll take it to the grave.
You can, but you just need to pick somebody that's a specialist in that area.
Yes, right? But again, it's like, what? But are you going to listen to them? Do you know what I'm saying? It's like if you go
find somebody to tell you whatever you want to tell you. I think what you find, especially in my industry, is that this I don't know a better way to say this, but the less successful an advisor is, the more they're willing to change for each client.
That
right?
makes
because
sense.
It's like
you cater to, because you're trying to get more business. It's simple marketing as well. In the market, like people who have a niche or specialty or things like that, it's sometimes harder to find your clients because your net is so narrow. But then the depth of clientele that you can get is like that's deeper. I don't know how to say it. The depth is deeper.
Yeah, I would agree. Because it's like, oh, this is the exact type of, and I built my entire system around helping somebody that looks exactly like you. But there are definitely, and the thing is that within the investment philosophy specifically, there are lots to pick from, right?
So what do you mean by investment philosophy? Because I think that would confuse people. Like, what is an investment philosophy?
Yeah. Okay. So the best way to describe it, and like half of people listening aren't going to have a clue and half of them will. But for example, sports is the best way to describe it, right? And the World Cup's on. So football.
Yes.
Not soccer, football.
Yep.
There are many different ways to attack, right? There are lots of different formations that you can use to play the game of football. Okay. I keep saying football.
Yeah, you go for. I'm so used to it. I don't even. I when I read to Araya, like in books.
Yeah.
I'm like, and this is football, or in America, soccer, and I call football.
Yeah.
American football.
There you go. Good.
I know.
Good.
I've been
raise her right.
What's the word? I want to say contaminated, but that's not right. What's the word where it's like somebody's convinced you of something? Anyway, that's what I am. I'm pro English.
It's good. So, but you're all playing the same sport, and it would apply to. I only know football's a sport I know the best, but it apply to hockey and all those type of things. Mm-hmm. That different formations, you can be pressing, you can man mark, you can lots of different ways to play the same game, and
like more defensive, more attacking.
There's probably an endless amount of small adjustments that some big adjustments, some small adjustments, but they're all playing basketball, they're all playing football, right? They're all playing tennis, but there's lots of variations. With investing, there's exactly the same approach. I choose to use something that's a little bit more objective it's a little bit more researched. It's based heavily on research, and that's simply that companies that are invest in themselves to grow, companies that are profitable, basically the two major ones, like higher quality companies will in the long term outperform companies that don't have those type of characteristics. Sounds very simple, but it's not always true, especially in the short term. When you look at companies that grow significantly, like you're talking about, like these, there's plenty of examples, like Bloom Energy is just a example that comes to mind, but it's just a small energy company that was providing efficient energy to data centers and things like that. Grew incredibly quickly, didn't have those characteristics, right? So my investment philosophy isn't to target those one-hit wonders. It's to reduce the risk of a bad outcome over somebody's lifetime, right? Like not next 5 years, not even the next 10 years. I have no idea. It's just a good way to invest, and it allows me to then, that's the philosophy. I then apply that philosophy, I build my portfolios on it, and then I build my planning around those portfolios. So there's very few situations where I don't know how the portfolio is going to look because I have my expectations and I know
you've planned around.
I've planned around it, right? I've looked into great detail into exactly what I'm expecting from the various parts of the way that I invest money within the planning framework that I use. So that's what I mean by investment philosophy. So that's the one I use, but some people are diehard active managers that they think picking individual stocks is the way to go, right? Regardless of what I think about that, that comes with very different expectations from a portfolio than somebody else, right? And than my approach, right? Because the tax drag looks very different, tax profile. Another example is for my fixed income piece, I stick with investment grade, higher quality Canadian because I don't want to introduce, or I want to minimize the risk of currency within I call it a war chest. So it's the point of those funds are, if markets crash, the world's on fire, I need them to be there. So because that's how I approach fixed income, it means that from an investment philosophy point of view, I do not introduce certain types of risk. I do not want to see significant default risk where I am now lending to companies that have any real chance of not paying me back just because they're paying 0.5% more. To me, it's not worth it, right? That's my investment philosophy. And it means that I then plan around that. It means that my equity allocation may be a little bit higher than what somebody else's might be because I'm not willing to increase certain types of risk in my war chest, right? Because I just see the downside is so much greater than the upside because the upside's so limited. So things like that, part of somebody's investment philosophy. But as soon as somebody, let's say I was working with somebody, which I wouldn't do it, but let's say I was working with somebody and they're like, hey, I really want to own this Brazilian company's, tech company's bonds that they just released because it sounds interesting. And that's what I want my safety net to be in.
The answer is no.
We're now outside of my area of, I don't know how that's going to impact. I've never looked into what the impact would be. I'm not going to for this one change, right? Like it's just simply, if you're going to work with somebody, then you really should work within their comfort zone and where they have delved really deep into. And if you're not, and the person says, you walk into somebody, you're interviewing people and they say, okay, well, we can do, our job is to adapt every portfolio, all the investment philosophy to every individual client. I can guarantee that the advisor has no idea it's just, there's too many different types for them to truly be able to do a completely different portfolio, completely different investment philosophy
and adapt everything
for every single client. It's just not.
Yeah.
It's just you're very likely dealing with somebody that's an amateur. Normally, people they'll be able to they'll have investment philosophy. They'll better explain it and they'll better defend it.
Yeah. So then, at the beginning of the episode, the intro said, "What did you say? Something about the philosophy and why it doesn't really matter."
Yeah.
So then.
Okay, let me get back to that. So it matters. I'm going to say not that it doesn't matter. I would say that it matters a lot less than what people think.
Okay.
So, for example, high dividend strategies have been like a mosquito light to humans, but like a draw because the thought process behind it is really comforting. So the thought process behind high dividend strategies is that you buy companies that pay high dividends. That means that the cash flow is coming off of that stock, whether that stock is up or down. And then with that money, you can buy back more stock if you wanted to, or you can spend it. But no matter what you're doing, no matter whether the stock's up or down, it's paying off this dividend. It's paying off cash flow. So therefore,
you get money.
you get money, right? And while that doesn't hold up at all, and
I think we've talked about this in a previous episode.
have we? Okay.
I think so.
Okay, well, it doesn't hold up. It doesn't truly hold up, but it does sound really good. If that is what it takes for you to stick through all the ups and the downs in the market, and you can plan your life or like your financial decisions around that choice, go for it. If that's what it takes, then that is the way that you should invest, because you're going to have more success doing that than switching to a momentum strategy. So a momentum strategy is basically companies, and it's proven, it's just very volatile. So companies that are going up tend to go up more. It's basically what it means.
Yeah.
So until they don't. It's the
They can
until they
only grow
don't. That's
so
the
big.
scary part. Yeah. But that is a legit strategy with evidence to show that that does work. It's extremely volatile. If you're okay with that extreme volatility, then pick that strategy. Just know there are consequences that come from that. Some of the consequences mean that you have to pick an active manager to do it, right? That's pretty much standard. And so it's going to be more expensive. And they have to buy and sell stocks, which means that you could have a very high turnover inside the portfolio, which means that your tax drag is going to be significantly higher than a different type of approach, right? And that might change the investment philosophy you choose to use. Whatever it is, if you plan around those key items changing, that's fine, right? Then do that. The mistake that people would make, and you'll see it the most, and it's what happens when you have an advisor that knows one strategy really, really well and they try to adapt and all that stuff, is that they'll be using a momentum strategy, but using the planning framework that somebody like me would use, and it doesn't translate. It doesn't translate because suddenly you're getting tax consequences that you don't expect in the corporation, or you're getting too much income in the personal. It just doesn't work because the foundation is just so different. You've built the house out of the wrong material for that
Foundation.
Yeah.
Yep.
Right. Does that make sense?
Yep, I think so. I mean, it was quite the tangent, but I gotta bug you.
Yeah, sorry.
No, it's okay.
Okay.
It makes sense.
Okay, good. So that's why it doesn't, there's lots of good strategies that I think you can get behind and stick to. It's just that the investment and the planning side need to be looked at. Yeah. That's a great, they need to be married. And
Did you like that?
in order for you to do that, you just want to stick within that framework.
Yep.
Okay.
No, that makes sense.
And it has to be an investment philosophy that you can stick to during downs, because every single one of them has a down.
Yep.
Okay, let me rephrase that. Every single investment philosophy that works in some capacity has a down. Because, I mean, it'd be a great investment philosophy. It's just like buy it when it's going up and sell it when it's all down, just before it all goes down. That'd be the best.
I was going to say, I'm like, that sounds like a terrible philosophy. Buy it when it's high, sell it when it's low, and make no money. That's a guarantee.
You lose money.
That I can guarantee.
I mean, do the complete opposite of that. Buy it just before it goes up, and then sell it just before it goes down. That is the best investment strategy you can. Nobody
just
can
know
ever
the
do.
future always.
Do, absolutely.
Go back in time, or go ahead in time.
Yeah.
Move time.
Yeah.
That's the strategy.
That's the strategy. It works. I think I kind of answered that.
Yep.
Right?
So then it's basically like, if not to like make more out of this episode, but just to wrap it up. So if somebody is looking for an advisor and they're like, oh, okay, I listened to this podcast and I'm supposed to ask you about your philosophy. What's your investment philosophy? I guess if the advisor doesn't have an answer, is that a red flag?
Yeah, for sure. Absolutely.
If they're like, we adapt. Okay, so that's a bad red flag. If they're like, here's my philosophy, as the consumer, I guess, do I have to know the philosophies, and do I have to?
If it's you don't have to know all the philosophies, but you need to know if it's a philosophy you can get behind.
Okay.
Because this is the way your money is going to be invested. So
Yeah.
if it's
So it's like I have to understand what this person is doing.
At least the basics, right? Like the overall, what they're trying to achieve and accomplish. Yeah. And you could do that through a quick Google search.
Yeah.
Relatively easily.
Yeah, that makes sense. And then you got to like the person. So it's like, I guess interviewing would kind of be annoying. I feel bad for people. I'm like, I got mine. So easy. Just
marry one. Yeah, there you go.
Done. I'm like, you can never die, please, because I'm like, I don't want to do this.
You have your instructions.
I'm just going to go back and listen to our old podcast episodes and be like, what do I do?
Well, I made a video for you.
Tax,
you have that.
right?
You have that video.
Dividends. Always invest in bonds.
Yes, that is definitely.
I'm just kidding.
Definitely.
I'm just joking.
Okay, anyway, we're just dragging this on.
Yeah.
Okay, thanks for listening. See you guys in the next one.
Bye.
Bye. Thanks for listening to this episode of the Plain English Finance Podcast. Tré Bino, Certified Financial Planner, Chartered Investment Manager, is a financial planner with TC Wealth Management and Aviso Wealth. You should always consult with your financial, legal, and tax advisors before making changes. This podcast is provided as a general source of information and should not be considered personal investment advice or solicitation to buy or sell any securities. The views expressed are those of the individual and are not necessarily those of Aviso Financial Inc. Mutual funds and other securities offered through Aviso Wealth, a division of Aviso Financial Inc.